Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. Some of you may not agree, but to me the biggest global news of the past week was Scotland's first victory over England at Twickenham in 38 years. What made this epic victory especially sweet was the role South African-born players played in it. Duan van der Merwe scored the only try, while WP Nel and Ollie Kebbel dominated the English front row when they came on as substitutes. Former Stormer Hugh Jones also featured off the bench. As of last night, more than 108 million people have been infected with COVID worldwide, and over 2.4 million people have succumbed to the disease. The United States remains the hardest hit with more than 28 million infections and more than 485,000 deaths. India, Brazil, the United Kingdom and Russia make up the top 5, and South Africa still has the 15th most recorded cases. The strenuous efforts to limit the spread of the coronavirus, combined with aggressive vaccination programs, have resulted in the number of new cases reported declining almost everywhere. Sadly, the United States is once again the exception, with new cases on the rise. Experts warn that optimism over the effective vaccine should not lead people to act irresponsibly. The world is still 6 to 9 months away from population immunity, and more contagious strains of COVID are emerging. The total number of deaths is thankfully also dropping as the impact of mass spreader events over the festive season is now behind us. There have nevertheless been worrying spikes in daily deaths in large countries like Mexico, Brazil, Spain, and France. The Biden administration has already exceeded its target of vaccinating 1 million people per day, but the EU's campaign is off to a slow start. The US and Chinese economies are recovering, but Europe's is floundering. In America, the Democrats are close to forcing a huge stimulus package through Congress, and India is turning to privatization to stimulate its economy. The fight against the coronavirus is adding to the world's aggregate debt level, and in America, the Congressional Budget Office is warning that too much stimulus will result in rising inflation. The second COVID-19 wave had a detrimental impact on global business confidence in January. In Britain, the green line, and the Eurozone, the dotted blue line, the respective purchasing managers' indices have dropped off into negative territory. China's PMI, the blue line, has also declined but remains well above 50. The US PMI, the black line, remains bullish though. Global debt levels have generally risen since the start of the COVID-19 pandemic. In aggregate, global debt now exceeds 3.5 times global GDP, as represented by the red line. The main contributors have been financial institutions, the area shaded in pink, governments, the light brown area, and corporations, the dark brown area. Households, the green area, have however been thrifty. In America, the nonpartisan Congressional Budget Office this week warned that excessive monetary and fiscal stimulus would ultimately result in the economy overheating and inflation flaring up. This typically happens when actual GDP growth exceeds the economy's long-term potential. For much of the past decade, actual growth was below potential, and this resulted in very low inflation. According to the CBO, the massive stimulus currently being administered needs to be reined in at some point if the US is to avoid overheating by 2025. Global equity markets remain on the front foot, with Wall Street leading the way. The oil price is benefiting from rising demand and lower output, and Elon Musk has taken a big bet on Bitcoin. Thanks to Brexit, the Amsterdam Stock Exchange now handles bigger volumes than the London market. Heineken is cutting back as beer consumption falters, and TikTok got a reprieve in America. Fiat has received EU approval to merge with Peugeot and Citroën. The recent sharp rise in US equity markets is not just the result of optimism over future earnings. It is also largely due to the massive amount of money being created by the US Federal Reserve. Last year alone, the US M1 money supply, which consists of the coins, notes, and demand deposits in circulation, grew by 75%. Like any oversupplied commodity, cash has become less attractive, and alternatives like equity have attracted huge inflows. The huge gains made on equity markets over the past year were by no means uniform. Not only did various markets produce widely varying returns, but even within the same exchange, the different sectors experienced diverging fortunes. Within the S&P 500, for example, technology and consumer goods rose by more than 40% each, while energy stocks were down by 30%, and financials and real estate were also in the red. Commodity markets are reenacting Aesop's fable about the hare and the tortoise, with the tortoise in this case being the oil price. During the second half of last year, the recovery in Asian manufacturing saw the prices of industrial metals rise sharply, while the collapse in travel kept the oil price depressed. In recent months, concerns over a second wave have left metals prices becalmed, even as falling inventories and rising futures orders have lifted oil back above $60 per barrel. Among offshore asset classes, we prefer equities. Firstly, because their dividend yields are superior to the interest yields of bonds and cash, and secondly, because the imminent recovery of the global economy should result in improved earnings and lift share prices. We see the biggest potential in emerging markets, while other developed markets should start catching up to the United States. Listed property faces both opportunities and threats, but we believe valuations are fair and dividend yields are attractive. Bond and cash yields are lower than inflation in most developed markets, and will stay that way as long as central banks continue to stimulate growth through low interest rates and inflating the money supply. In the government bond space, we prefer emerging market bonds, and where we are mandated to invest only in developed markets, we prefer high-yielding bonds to gilts. Locally, the week's big news was the underwhelming performance of the AstraZeneca vaccine in clinical trials. The vaccine is only about 20% effective in healthy adults and people suffering mild symptoms. Government subsequently announced that it would withdraw this vaccine from its mass vaccination program and replace it with the Johnson & Johnson vaccine. As of last night, nearly 1.5 million South Africans have tested positive for COVID-19, and more than 47,000 have succumbed to the disease. Gauteng has reported the highest number of infections, while the Western Cape has suffered the most deaths. Yesterday saw 237 new deaths, about half the daily average during January. The easing of the lockdown regulations should bring both emotional and tangible benefits. Last night's State of the Nation address disappointed in being more of a wish list than a program of action. Former President Zuma refused to appear in front of Judge Zondo, but was happy to have tea with Juju and Kebi of the MK veterans. PMIs squeaked in above 50 in January. Manufacturing and mining contracted in 2020, but at least vehicle exports rose in January. This graph proves that the sacrifices we were forced to make during the recent heightened lockdown were not in vain. The number of new infections, the blue line, have dropped by about 80% from its peak in early January, and the daily death toll has nearly halved. The elephant in the room is vaccination. Whether we have to brace for a third wave down the road will depend on how quickly government can get effective vaccines into enough arms. Despite the irritation caused by periodic load shedding, Eskom is behaving less like a headless chicken under Andre de Ruyter. Despite having to take power stations offline for long overdue renovation and maintenance, power output is starting to rise, and the power utility is also making progress in recovering some of the billions owed to it by its debtors, mostly local government bodies. The JSE is riding high, but nearly half of its growth for the year to date is due to Naspers. The rand continues to defy prophets of doom, and our bonds remain attractive to foreigners seeking yield. Apart from Naspers, the other major underpin of the all-share index is the resources sector. MTN has sold another of its offshore businesses in order to pay off debt. Last year, the all-share index was the ham in the sandwich between Naspers, the dark blue line, and the resources sector, the light blue line, on the upside, and everything else underwater. Between them, Naspers and its sister companies Process and MultiChoice make up nearly 30% of the JSE's market capitalization. This means that index investors are exposed to major concentration risk, while active investors whose exposure are below the index weight run the risk of underperforming when the Naspers table does well. Since the beginning of 2021, Naspers has continued its upward surge, and in the process it has buoyed both the industrial sector and the all-share index. Resources have continued to outperform financials. Banks and financial services are the dark horses for this year and could well surprise on the upside if the local economy does find its way out of the doldrums. Overall, the JSE looks poised for a general re-rating. The average price-to-earnings ratio of the all-share index, the turquoise line, is well below its long-term average, and way below that of the S&P 500, the red line, and a third below that of the FTSE 100, the grey line, which is the worst performing developed market index for last year. The rand briefly flirted with the 15 rand to the dollar level again this week, but ended the week as the best performing emerging market currency relative to the greenback. The other strong performances came from the Mexican peso and the Indonesian rupiah, both benefiting from higher oil prices. South African bonds remain attractive to foreign investors seeking yield, and last week saw an inflow of nearly 1.5 billion rand into the bond market. The JSE was less fortunate, and there was a net outflow of nearly 5 billion rands worth of foreign capital. On the domestic front, we have increased our tactical allocation to equities from underweight to just below neutral. We remain cognizant of South Africa's socio-economic challenges and policy follies, but given the favorable global backdrop and undemanding valuations, we are beginning to see opportunities among local shares. Government bonds remain our preferred local asset class. We are aware of the risks to the fiscal outlook, but South African bond prices have, in our view, already factored in a substantial risk premium. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.